Welcome, Michael. We understand you're a value investor. Which sectors in the market do you think represent the greatest value at this time?
Well, I think for longer-term investors, like our clients mostly are, we're finding more value now actually in the resource stocks, which have lagged so much over the last year. We have a position where the commodities have had such a terrible year, and Canada as a whole has lagged as a result. So I'd say overall we're finding more value in energy and materials than we are anywhere else at this point in time.
Are there any particular stocks that you like that you could tell our investor audience about?
Sure. In the energy side, we like Cenovus Energy. We can see that under various pricing scenarios going forward, they're going to have positive free cash flow commencing in the next year or so. And the expansion of production there is going to be quite impressive. And we really like the pricing on that model right at the moment. Another one that maybe is a little bit more contrarian is Talisman, which of course has got new management as of over the last year, and they have undergone a new strategic initiative. And basically whether they sell the assets in whole or in part, or develop some and sell others, it's really going to begin to surface value over time. What's holding the value down, of course, right at the moment is the fact that oil and gas prices have been a little bit depressed, but we believe that the parts in this case are worth much more than the whole.
What criteria do you use when deciding whether or not to buy a particular stock?
Well, mostly what we're looking for are companies that have got the financial wherewithal to withstand a period of less than optimal conditions. So we're looking for strong balance sheets, strong management, and historically we look at what has this company been capable of earning, what has been the return on equity traditionally, whether or not they might get back to that level. We try to assess over the next business cycle as we see it under various scenarios. What is the normalized ROE going forward, and what are you paying for that today? And then we compare that with what the market's asking for it and decide whether or not we think it's a buy.
The last time we spoke, you were concerned that North American stock markets were becoming overvalued. Do you still feel that way?
Well, we feel that way more so about the U.S. market than we do about the Canadian. I mean, we have a situation where for the year to date, the Canadian market's up a little over 11% on a total return basis, whereas S&P 500's close to 28%. The Russell, the broader index, is well over 30%. And this has been in the face of declining commodity prices over the year, which is what has held the Canadian market back. We feel that on balance, though, there's been a little bit too much optimism built into the U.S. market. The employment situation there is not improved to the extent that we think warrants the market running ahead to the extent that it has. We do believe that there is positive signs to be seen in the U.S. in terms of gains in employment, slow, better housing conditions, but overall we think that the market is certainly well ahead of where it would be given the economy today.
You previously mentioned that you like commodities. So which commodities do you favor?
Well, as I was saying a minute ago, we think that there's value to be had longer term in energy. Outside of that, we think probably you look at copper, nickel, the base building commodities, there's value to be had there as well.
So what is your outlook for the Canadian and U.S. economies?
Well, that depends a lot on what happens in the economy in general going forward. What we've had is a very tepid recovery to date, and going forward it's going to be a function of, is there anything that's really going to upset the apple cart, whether that be a geopolitical incident or otherwise. But we have seen reason for solid optimism lately. The downward slowing of growth in China seems to have abated to some extent. In fact, after a number of years, we're beginning to see a little bit more stability in the European market. And as we were saying, we are seeing some positive signs in the U.S. Now, a lot of that's been aided and abetted by the low interest rate environment and the quantitative easing that has been occurring in the U.S. And we have seen the market fear of what will happen if that quantitative easing dissipates. But we think that generally, once the economy has the legs under it to stand on its own 2 feet, that shouldn't be as big a worry.
Do you currently see better investment opportunities outside of North America?
No, as a matter of fact, I think that we see better investment opportunities in Canada in particular than we have seen in some time. Canada has lagged the global markets to the extent that I think the pent-up demand for commodities when economies begin to pick up again will cause the Canadian market to participate as well or better than most of the global markets.
Thanks for taking the time for the interview, Michael.
Thank you.
Subscribe to our daily newsletter and be the first to get expert insights and advice from our roster of industry specialists. smallcappower.com, investment ideas and research.